right, it's time now for Word of the Day, where we break down a financial term or concept for our smart viewer, but maybe not the financial expert. And since we've been talking about Treasury bonds today with Peter Cheer, and as a follow-up to last week's breakdown of ETFs focusing on precious metals in a Word of the Day, we have, again, ETF, exchange traded funds, as Word of the Day, but now with a special focus on Treasury bond ETFs, because the moral of the story with these financial products is always to read the fine print. And now we will give you another reason as to why. Let's dig a little deeper into one of the more popular Treasury bond ETFs. It's called the TLT, and it's managed by BlackRock, if you're interested. Now, if you think this ETF sounds like a safe investment because its underlying assets are U.S. government securities, which many consider a risk-free asset, you may be surprised to find out how much risk you're actually taking on. You probably thought I was going to say that, but let's take a look at the prospectus so I can show you the fine print. Exhibit A, the fund may engage in securities lending. Securities lending involves the risk that the fund may lose money. All right. Doesn't sound great. Later on, it goes on to state, the fund may lend securities representing up to 1/3 of the value of the fund's total assets. A third. So 1/3 of the underlying assets in the ETF, in this case treasuries, can be used as collateral to take out loans, to get cash. All right, let's continue because I'm not done. The fund also may invest up to 5% of its assets in repurchase agreements collateralized by U.S. government obligations and in cash and cash equivalents, including shares of money market funds. So let's put the pieces together because this is all like legalese after all. So TLT can lend up to 1/3 of its total assets in cash and then invest that cash in things like money market funds. And I should note, this is something you could only find out by reading the statement of additional information, a supplement to the prospectus. Okay, so we have that 33.33%. Then the fund can also invest up to 5% of its assets in repos, cash, and money market funds. So let's get this straight. Up to 38.33% of assets can be put in the money market. Now, let's see what this looks like in reality. Back to the prospectus. Well, what do you know? Lo and behold, 36.01% of the 20-year plus TLT Treasury bond fund is invested in money market funds. Now, there isn't necessarily a problem with money market funds, but this is certainly an area of additional risk, especially if you thought the underlying assets were a direct liability of Uncle Sam Malone. And just recall, so that we can have some context, the money market mayhem around 2008, after the collapse of Lehman Brothers in 2008, it gave rise to headlines like the ones you see rushing to save money market funds. Money market funds get $50 billion backstop from the U.S. So remember, before investing in an ETF, even in an apparently safe one, it is very important to do your homework. A sophisticated investor or trader may have good reason to use such an ETF, but if you're buying into the TLT as a long-run alternative to buying U.S. Treasuries sitting there at home, you may want to think twice about where you are parking your hard-earned money, and that is why we are breaking down, once again, ETF.